Welcome back to the Deep Dive. Our goal here is simple: to take a high-quality stack of research articles, internal memos, analyst reports, and extract the essential high-leverage insights you need to get smarter, faster. Today, we are undertaking a deep dive into a company that has, frankly, fallen hard from market grace. Carl Zeiss Meditec AG, or CZM.
CZM presents a fascinating high-stakes puzzle for the critical investor. We are looking at a premier medtech franchise, a name that is globally synonymous with German precision optics and engineering. It's a company that was historically priced as a technology compounder.
Right.
But it's currently trading at what can only be described as genuinely distressed multiples. The sources we reviewed paint a picture of a company navigating a perfect storm.
A perfect storm is the right phrase for it.
It is a severe confluence of cyclical market downturns, rapidly escalating geopolitical risk, intensifying competition, and some unfortunate internal governance issues.
That is the setup. So our mission for you, the intellectually rigorous investor, is to cut through the noise of the last few quarters. We need to answer a single crucial question. Is Carl Zeiss Meditec a true fallen angel, possessing enough underlying quality and durable moats to stage a significant valuation recovery once these current and perhaps temporary headwinds dissipate?
Or, and this is the big risk, has the landscape fundamentally shifted?
Turning it into a structural value trap.
Exactly, a value trap where increasing competitive and regulatory risks have permanently impaired its historical premium growth profile.
And the difference between those two outcomes is potentially 30 to 50% upside or, well, permanent capital impairment.
To frame this correctly, we have to start by acknowledging CZM's pedigree and strategic importance. It operates as a subsidiary of the venerable and highly successful Carl Zeiss Foundation. Its operations stand at the intersection of extreme precision optics and cutting-edge therapeutic intervention. But, while the legacy is solid, the business model itself is undergoing a strategic metamorphosis.
A big one.
Yeah. Management is trying to shift the revenue base away from those volatile, cyclical capital equipment sales, the big, expensive one-time laser sales to hospitals, and toward a much more stable, annuity-like recurring revenue model.
And this transition, coupled with the pain of the last 2 years, is precisely where this massive valuation tension originates. For the better part of the last 5 years, this stock was consistently priced by the market as a bulletproof quality growth compounder.
It demanded and received an average price-to-earnings multiple in the vicinity of 43 times.
43 times. Today, if you look at the consensus estimates, CZM is trading at a PE multiple closer to 25 to 28 times earnings.
That is a brutal 35 to 40% discount.
Not just to its peers, but to its own historical self. The market is not pricing in quality anymore.
No, it's pricing in decline, disruption, and risk.
Which presents the asymmetry.
Absolutely. If the current margin compression and the slowing of organic growth are genuinely transitory, caused by factors like short-term integration costs or cyclical destocking in China, then the upside potential from multiple reversion alone is immense.
But if the geopolitical risks are for real?
If, however, the geopolitical risks, particularly the risk of regulatory price cuts in China, are structural and permanent, then the current discounted price might simply be justified. It would just be reflecting a lower long-term growth rate.
Okay, let's unpack this.
Right. Let's drill down into the competitive advantages and the fundamental business quality that earned CZM that 43x premium in the first place. Because those assets, they haven't disappeared.
Okay, let's start with the operational engine. CZM isn't a monolith. It's a dual-engine company with two highly specialized and distinct divisions. They serve completely different end markets and provide very different levels of stability.
Indeed. We look at the bifurcated operations, ophthalmology or OPT and microsurgery or MCS. Understanding the dynamics and the margins of each is crucial because they really do serve very different purposes for the investor.
Let's start with ophthalmology, the OPT division. This is the undeniable growth engine. It accounted for about 77.4% of CZM's total revenue last year.
That's right. And this is the division focused on the entire patient journey for vision care, from diagnosing issues like glaucoma and cataracts, all the way to correcting refractive errors.
And within OPT, we immediately hit the first durable competitive advantage, diagnostics.
Yes. CZM is the market leader in key areas like biometry with their IOLmaster 700 and in optical coherence tomography, or OCT, with the Zeiss 6000. These are just essential tools for measuring the physical structure of the eye.
But every medtech company has diagnostic tools. Where does the real moat lie here? What makes Zeiss different?
It lies in the core, superior Zeiss optics and the software integration. The precision they offer is not just incremental, it's performance-defining. Okay, take the IOLMaster 700. Its swept-source OCT technology provides an extremely high signal-to-noise ratio and image resolution. This allows surgeons to image eyes that might be too dense with cataracts for a competitor's older technology.
Ah, so it directly translates into better clinical outcomes.
Directly. Fewer measurement errors, more accurate intraocular lens or IOL, power calculations, and that means fewer postoperative redo surgeries.
Which for a busy ophthalmologist is a huge deal.
It's a massive, tangible economic advantage that justifies paying a premium for the Zeiss system. That certainty and efficiency is everything.
Moving from diagnosis to intervention, then we hit the crown jewel, refractive lasers. This is the technological differentiator that really made them a high-growth darling a decade ago.
We are, of course, talking about the Valuatio platform.
The machine enabling their proprietary SMILE procedure, small incision lenticule extraction.
And this procedure fundamentally differentiated CZM. It offered a flapless, minimally invasive alternative to traditional ESIC. The technical details are critical here, especially with the latest version, the Valuatio, which they market as SMILE Pro.
Right. The speed is the key.
The leap they achieved in speed is staggering, and it speaks directly to clinic economics, which is what you, as an investor, really need to focus on.
So tell us about that speed advantage.
The Valuatio reduces the actual laser treatment time to a jaw-dropping under 10 seconds.
Under 10 seconds.
Some sources even say as low as 8 seconds. Now, compare that to the time required for earlier procedures.
So why does this matter so much?
Well, first, patient comfort and anxiety are reduced, obviously. Second, the risk of suction loss, which can completely ruin a procedure, is drastically minimized because the patient is only under vacuum for a very short time.
But the real kicker is for the clinic owner.
Most importantly, yes. For the clinic owner, reducing laser time means they can substantially enhance clinic throughput.
More patients per hour.
If a surgeon can do 15 SMILE procedures an hour instead of 8, the revenue potential of that clinic is nearly doubled. This speed advantage is a measurable economic moat that competitive systems really struggle to match.
Okay, that's the OPT growth engine. Now let's pivot to the second, smaller segment, microsurgery, or MCS. This is about 22.6% of total revenue. Why do we describe this one as the high-barrier cash cow?
Because it's where CZM's brand trust and technology meet the absolute highest level of mission criticality. MCS focuses on advanced visualization solutions, surgical microscopes, robotic visualization systems for fields like neurosurgery, spinal surgery, and ENT procedures.
Places where you absolutely cannot afford a mistake.
Exactly. In these fields, the difference between perfect clarity and slight distortion can be life or death.
And their flagship device here is the Kinevo 900S. What makes this piece of equipment so special, so technologically supreme?
The Kinevo 900S is effectively a robotic visualization system. It's highly integrated and automated, and it have key features like point lock and position memory that are just non-negotiable necessities for surgeons.
Explain what those do.
So point lock allows a neurosurgeon to pivot the microscope's angle and magnification around a precisely defined, fixed focal point deep inside the brain without ever losing focus or having to manually adjust.
Wow.
And position memory allows them to recall those precise settings instantly. This level of robotic precision is mission critical. I mean, a 9-hour surgery demands absolute reliability and consistency, and Zeiss delivers that.
And I imagine this reliance dictates a market structure.
Absolutely. This segment operates in a stable global duopoly. It's almost entirely dominated by CZM and its primary competitor, Leica Microsystem.
Which is owned by Danaher.
Right. And the barriers to entry are not just high, they are astronomical. It requires decades of accumulating specialized optics R&D, navigating deep regulatory hurdles, and, most crucially, overcoming the extreme risk aversion of surgeons.
A surgeon who has used Zeiss for 10 years isn't going to switch to some startup for brain surgery.
No way. They trust it implicitly. They will not switch to an unproven third-party competitor. This stability provides an incredibly resilient earnings floor for the entire CZM enterprise. It offers a counter-cyclical buffer when the OPT segment slows down.
Okay, so let's move beyond the physical hardware, which is where the analysis gets much more sophisticated. And here's where it gets really interesting for the critical investor looking for lasting economic advantages. The digital walled garden ecosystem moat.
Yes. Cesium has deliberately focused R&D on engineering high switching costs that extend far beyond the physical life of their lasers and microscopes.
This is the modern intangible moat that separates the enduring compounders from, the mere hardware vendors.
Right. And the core of this digital system is Zeiss Forum. You should think of Forum as the operating system or the central nervous system of the entire ophthalmic clinic.
So it's the central data repository.
Exactly. It takes data from every single diagnostic device, the IOL master, the Cirrus OCT, and connects it directly to the surgical planning tools.
Okay, it facilitates data flow, but how does it create the lock-in?
The operational friction involved in switching away from Forum is immense, and that's the definition of a high switching cost. Once a clinic integrates Forum as its primary patient data backbone, they have potentially terabytes of historical patient records, surgical protocols, custom settings, all stored and optimized within that ecosystem.
And migrating all of that data to a competitor system,
Say an Alcon platform.
retraining every technician and surgeon, risking any interruption in that data flow.
It's an operationally painful, high-cost proposition that clinic owners will actively avoid.
They intentionally deepened this digital lock-in even further with the acquisition of Veracity Innovations.
That's right. Veracity added a powerful, cloud-based surgical planning tool. It integrates electronic medical records with diagnostic data to automatically calculate IOL power and plan complex surgeries. This isn't just a convenience, it's workflow integration.
It saves time and prevents errors.
Crucially, it virtually eliminates manual transcription errors that can lead to devastating surgical mistakes. So the investor takeaway here is that Cesium's R&D spend is successfully shifting from delivering only new hardware features to building a pervasive data ecosystem that creates lasting operational dependency.
It secures future revenue streams regardless of whether the hospital buys a competitor's microscope next year.
They are locking in the data, not just the device.
Finally, let's address the elephant in the room that underpins all this pricing power: intangible assets and brand heritage.
We keep referencing superior optics, and that brings us back to the Zeiss brand itself. The 175-year heritage of the Zeiss name acts as a tangible economic asset, not just a marketing claim.
In the medical field, trust is the highest currency.
It is. When a surgeon is choosing visualization equipment for a delicate procedure, they look for minimal risk. They've used Zeiss optics as the benchmark for clarity, precision, and reliability. This confidence translates directly into an ability to charge a premium.
And we see that premium reflected clearly in their reported financials, even during this current crisis.
Absolutely. The sources show their gross margins consistently staying above 52%.
52%.
This is significantly higher than many general med tech peers, whose gross margins might hover in the 40s. That 52% margin is proof of substantial pricing power and resilience.
And it's the key reference point we have to remember when we discuss the painful collapse of their operating margins later on.
Exactly.
So we've established the underlying quality and the deep moats. But that quality hasn't prevented the stock from being hammered. The primary critique of Cesium for years was its earnings cyclicality. It was just too reliant on hospitals' discretionary capital expenditure budgets. This brings us to Section 2. The structural pivot to recurring revenue.
And this pivot is the absolute core of the bull thesis. Management has been aggressively working to structurally mitigate that historical cyclical risk by executing a classic razor and blade model acceleration.
If they succeed, the market will eventually be forced to re-rate the stock.
It will. It becomes a higher quality, less cyclical earnings stream.
And the data shows this shift is actually happening.
It is. The key metric we need to watch is recurring revenue, which includes high-margin consumables and guaranteed service contracts. This metric reached a record high of 50% in fiscal year 2024-25.
50%.
And crucially, this is up substantially from around 40% just a few years ago. This 10 percentage point shift fundamentally changes the profile of the business. It dampens earnings volatility and vastly improves cash flow visibility.
Which is exactly what a high-quality compounder should deliver.
Right.
Let's look at the drivers of that essential consumable growth, starting with the refractive business.
Okay, so the Smile laser platform is the epitome of the razor and blade model. The VisiMax laser is the capital razor, and the proprietary treatment pack is the consumable blade.
Every single procedure requires a new blade.
Every single Smile procedure performed requires a bespoke, single-use, high-margin treatment pack. This transforms that massive, cyclical, one-time capital sale into a multi-year annuity stream.
So the more successful the VisuMax install base is,
The more resilient the overall revenue becomes, because that consumables revenue is generated year after year, regardless of whether a new machine is sold.
Now, the second, and perhaps more controversial driver of this recurring revenue goal is the massive capital bet they made, the inorganic growth. The nearly €1 billion DORC bet the acquisition of the Dutch Ophthalmic Research Center.
This was a deeply strategic, near €1 billion acquisition, and it was aimed squarely at accelerating that recurring revenue mix and plugging a strategic hole.
A hole in their product lineup.
Yes. Prior to DORC, CZM was an insignificant player in the high-growth, highly technical field of vitreoretinal surgery, the complex procedures for the back of the eye.
Which is very consumable intensive.
Highly consumable intensive. Think specialized fluids, disposable high-speed cutters, fiber optic probes, things like that.
So the strategic rationale was about becoming a one-stop shop and basically buying their way into an annuity stream.
Precisely. DORC brought the highly regarded EVA and CUS platform and a strong reputation in retina. This deal allows CZM to offer a complete surgical suite, a full range of solutions covering the entire eye, front to back. By bundling retina consumables with their existing offerings, they can match the integration strategy that larger competitors, like Alcon, have successfully used to lock in customers.
What's the immediate financial context of this deal, especially since the market seems to be punishing them for it right now?
DORC contributes roughly €200 million in annualized revenue and strongly boosts the recurring revenue mix, as intended. However, this is where the short-term financial pain comes in.
And the investor have to understand the accounting friction.
Yes. The costs of integrating two large businesses, merging supply chains, harmonizing sales forces are high and immediately hit the bottom line. More critically, we have to talk about PPA amortization.
Okay, let's unpack that jargon for a second. PPA, purchase price allocation. That's essentially the accounting charge they have to take against the premium they paid for DORC's intangible assets, right?
That's a perfect way to summarize it. Things like customer lists, brand value, existing tech. Because CZM paid a significant premium over DORC's tangible book value, they're required by accounting rules to amortize that premium.
To write it down.
To write it down over a set period of years. This amortization is a non-cash expense, so it doesn't affect actual free cash flow, but it is a substantial temporary drag on the reported EBIT and EBITDA margins.
How long does that drag last?
Sources suggest this PPA drag could persist for 5 to 10 years, depending on the asset classifications. It keeps the reported profitability artificially suppressed.
And the market, unfortunately, tends to punish reported EBITDA even if the underlying cash flow is still robust.
It hates complexity and opacity. This transitional friction is a core reason why the stock trades at a discount.
So the discount is partially justified by integration risk, but structurally exacerbated by accounting rules that punish the transition. It's a classic case of accepting short-term pain for long-term structural improvement in revenue quality.
Right. Now we shift our focus outward. The strength of those internal moats and the success of the recurring revenue pivot are being severely tested by the external operating environment.
This is the massive tug-of-war that ultimately determines the long-term growth rate.
It's powerful secular tailwinds pulling demand up versus acute geopolitical and competitive headwinds pushing margins down.
Let's start with the durable forces, the demographic dividend or the secular tailwinds. These are the powerful demand drivers underpinning CZM's valuation floor.
The things that guarantee procedural demand regardless of quarterly economic shifts, and they are simply undeniable. First, global aging.
Cataracts, glaucoma.
Age-related macular degeneration. They are fundamentally diseases of aging. The global population aged 60 and older is growing faster than any other group. By 2030, estimates show that 1 in 6 people globally will be 60 or older.
Which guarantees a perpetually rising procedural volume.
Guaranteed. CZM sells the necessary tools to address this inevitable degradation of sight, so their TAM is structurally expanding.
Second, and perhaps even more significant for their high-margin OPT division, is what's being called the myopia pandemic.
This is a truly massive, expanding total addressable market that feeds directly into their highest margin refractive surgery business. We are witnessing a global explosion in nearsightedness driven by environmental and lifestyle factors.
Especially in East Asia.
Particularly pronounced there, yes. Current epidemiological estimates are sobering. By 2050, close to 50% of the world's population could be myopic.
That's an incredible statistic.
It creates a self-fulfilling demand curve for refractive surgery solutions like SMILE. Younger, affluent, educated generations worldwide are seeking spectacle independence. The TAM for refractive correction is expanding far faster than global GDP.
Okay, now for the headwinds. For nearly a decade, CZM had a blue ocean monopoly on lenticule extraction. That era is definitively over. We are seeing intensifying competition. The refractive war.
The strength of Smile was that it was unique, proprietary, and unchallenged. That changed with the entry of a major, well-capitalized challenger.
The challenger, of course, is Johnson & Johnson Vision, which has launched the Elita system.
Performing the silk procedure, or smooth incision lenticule keratomelusis.
And this is a genuine threat.
It's a genuine high-caliber technological threat that cannot be dismissed as mere marketing competition. J&J's Elita system uses a much higher laser frequency, 10 megahertz, compared to the 2 megahertz used by the Valuatio 800.
Let's break down the practical implications of that higher frequency. What does 10 megahertz deliver that 2 megahertz doesn't?
The higher frequency and lower pulse energy are designed to minimize the collateral damage zone in the corneal tissue. The idea is to get a potentially smoother corneal bed following the procedure.
And what does that mean for the patient?
Early clinical data suggests this might translate into two critical competitive advantages. First, potentially less postoperative inflammation, and second, critically faster visual recovery times. If a patient recovers perfect vision a day or two quicker with Silk than with Smile, that can become a powerful marketing tool for clinics, particularly in highly competitive consumer markets like China.
So even though CZM has a massive first-mover advantage, J&J's entry threatens their pricing power.
It threatens their ability to maintain premium pricing and, more importantly, its dominant position in new system placements. The transition from monopoly to duopoly, regardless of the relative quality, inherently compresses margins.
Shifting gears, the single largest source of volatility, the core reason for the valuation discount, is the China factor.
Geopolitical and regulatory risks. China accounts for about 25% of the group's total revenue and, crucially, a disproportionately high share of their historical high-margin growth.
China is the double-edged sword.
Growth is massive, but the sovereign risk is existential. This stems primarily from volume-based procurement, or VBP.
And VBP is the Chinese government's aggressive mechanism designed to centralize purchasing and just dramatically drive down prices for medical consumables and equipment. We've already seen VBP impact CZM's business, haven't we? Specifically in the intraocular lens, or IOL, segment.
Yes. The VBP rollout for IOLs resulted in price cuts of 50 to 80% on those products.
50 to 80%.
That is a permanent structural reset of profitability for that specific product line in a major market. But the true and often discussed black swan risk for CZM investors is the potential expansion of VBP
to refractive consumables,
meaning the proprietary Smile treatment packs.
That would be catastrophic, wouldn't it?
It would fundamentally impair the high-margin annuity stream that the entire razor and blade model relies upon. If VBP were to mandate a price cut of, say, 70% on those proprietary consumables, the economic engine of the VZMAX install base would be structurally impaired overnight.
That is the single largest threat to the investment thesis.
It is, and the market is demonstrably pricing in a high probability of this risk materializing, given the current low valuation multiple.
So what's the countermove? How is CZM mitigating this VBP and geopolitical risk? They've been executing a very capital-intensive local-for-local strategy.
This is a defensive move really necessary for market access. To hedge against import restrictions, potential future tariffs, and increasingly nationalistic buy China procurement policies, CZM has established significant manufacturing and R&D hubs in key areas like Suzhou and Guangzhou.
So they're localizing production.
They're actively localizing production of platforms like the Pentero 800S microscope for the Chinese market. This requires substantial ongoing capex, which suppresses short-term free cash flow, but it's considered essential for maintaining access to the world's largest and fastest-growing procedural market long-term.
They're sacrificing short-term capital efficiency for political and regulatory survival.
That's a good way to put it.
Given all these external pressures, geopolitics, VBP, the J&J threat, the internal stability of the company is more critical than ever. Unfortunately, this is where we hit significant governance turbulence. It starts with the jarring news of the governance crisis, the CEO dismissal.
The abrupt dismissal of CEO Maximilian Forrest in December 2025 was a massive shockwave that hit the stock price hard. It is absolutely crucial to note what the supervisory board stated, though.
Which was?
The dismissal was due to a code of conduct violation related to a conflict of interest from his prior tenure as head of Zeiss Greater China, specifically regarding internal disclosure obligations.
And they were emphatic that it was not related to financial irregularities or operational fraud.
Correct. But regardless of the cause, the timing is truly shocking. It creates a major leadership vacuum right at the moment of maximum strategic stress.
Precisely. Forrest was, for better or worse, the architect of that high-growth China strategy. His departure removes the executive with the deepest commercial and political understanding of their most volatile yet vital market.
Right, when they are desperately trying to counter VBP expansion and navigate the competitive threat from J&J, the market interprets this timing as a hugely destabilizing factor.
The interim leadership has fallen to Andreas Pecher, the CEO of the parent company, Carl Zeiss AG.
And while this provides stability, it also raises questions. Pecher is a veteran, known for his time leading the highly rigorous semiconductor manufacturing technology, or SMT, division.
The parent group's crown jewel.
Yes. He undoubtedly brings rigorous operational discipline, a focus on efficiency, and a deep understanding of complex German engineering. That discipline is sorely needed.
But his dual mandate is a concern.
It raises legitimate concerns about bandwidth and dedicated commercial focus on the medtech segment. The market desperately needs a permanent CEO appointed soon, and that individual must have deep, proven medtech commercial experience.
Now, let's shift to capital allocation, specifically M&A, because the DORC acquisition looms large. We have to scrutinize their track record, particularly the ENTech warning sign.
This failure casts a shadow of skepticism over the current €1 billion DORC deal. CZM acquired ENTech in 2018 for the MyLoop device, a technology intended to revolutionize cataract surgery.
But it didn't pan out.
No. In the 2023-24 annual report, they were forced to record a significant impairment, a write-down, on the intangible assets of this acquisition because the commercial adoption failed to meet original planning assumptions.
So the technology itself didn't fail, but the adoption strategy, the commercialization did.
Exactly. The technology failed to achieve anticipated standard of care adoption among surgeons. For the critical investor, this raises valid, actionable concerns about management's internal due diligence processes.
And its ability to accurately identify and value M&A targets.
Exactly. Given the sheer size of the DORC acquisition, investors must monitor its integration and commercial success with extreme caution. This single write-down increases the perceived risk of the larger bet they've made.
Let's discuss R&D efficiency and cost controls. CZM is famous for its high spending, consistently investing around 15 to 16% of revenue back into R&D.
Which is significantly above the industry average. And historically, that high R&D delivered breakthrough products like Smile. That spending was justified.
But the data shows that in recent years, despite this massive investment, organic growth has slowed and operating margins have compressed significantly.
Which suggests a classic case of diminishing returns on innovation investment, a measurable decline in R&D efficiency. The money is being spent, but the market-moving products are not arriving fast enough to offset the pressures.
What has been management's pragmatic response to this operational pressure, particularly under the new interim leadership?
Recognizing the need to restore operational leverage, they've initiated a formal cost-cutting and efficiency program in late 2024. The success of this program is a primary KPI for the interim CEO.
They have to show they can control their fixed costs.
They must demonstrate that they can control their operating expenditures so that the cost base grows slower than their recovering revenue. If they can restore leverage, those EBITDA margins can rapidly revert upward.
Okay, let's quantify the financial distress the market is reacting to. We need a clear margin bridge analysis to understand why the EBIT margin collapsed from that 18 to 20% range down to 11 to 12%. This dramatic 40% reduction in profitability is the single biggest driver of the valuation discount.
We can break this down into 4 critical drivers, a mix of structural, cyclical, and transitional factors.
Starting with driver 1, product mix and consumer downtrading.
We saw a massive cyclical and structural drop in high-margin refractive consumable sales, particularly in China. The Chinese market experienced a period of consumer downtrading, where patients, facing economic uncertainty, switched from the premium-priced Smile procedure to older, cheaper procedures like standard LASIK.
And CZM doesn't play in standard LASIK.
Right. When patients switch, that loss of volume on the proprietary Smile treatment packs creates a cascading negative operating leverage effect. The downtrading to a competitor's LZIC product represents a huge hit on that high-margin segment.
Driver 2. Transitional drag from DORC integration.
This is the intentional short-term pain we discussed. While DORC offers strategic benefits, the combination of immediate integration costs and the non-cash PPA amortization creates a guaranteed temporary structural drag on the reported EBITDA margin.
And analysts estimate this effect alone is responsible for several percentage points of the margin compression.
At least.
Driver 3 is the permanent structural hit.
Yeah.
VBP pricing compression in China.
The IOL price cuts, which in some cases stripped 80% off the selling price of the lens, are permanent. This structurally resets the baseline profitability of the IOL segment forever. Even as volumes recover, the revenue generated per lens will never return to pre-VBP levels.
And finally, driver 4, the exogenous headaches. Unfavorable FX and tariffs.
The company has recently faced unfavorable foreign exchange hedging outcomes. Moreover, there is a tangible stated risk of potential 15% U.S. tariffs on EU medical goods, which would hit major export platforms coming out of Germany.
This truly was a perfect storm where cyclical, structural, and external factors converged to crush profitability simultaneously.
It was.
We must also examine the crucial topic of cash flow volatility and balance sheet shift. For a business that commanded a premium for its financial fortress characteristics, low debt, high cash, the free cash flow generation has recently become volatile.
The pressure points are clear. First, working capital issues. During the peak of the global supply chain crisis, CZM prudently built up high inventory buffers. As supply chains normalized, they struggled to unwind this intentional inventory bloat, tying up cash.
And second, high capex.
Those new politically necessary manufacturing sites in Suzhou and Guangzhou, part of the local-for-local strategy, required significant non-discretionary capital investment, further suppressing free cash flow.
And the balance sheet has fundamentally shifted from a net cash position, which offered a cushion, to a net debt position.
The DORC acquisition was paid for through a combination of cash and debt, resulting in a shift to a net debt position of approximately minus 384 million euros.
While their balance sheet remains strong compared to many peers, the loss of that net cash premium is significant.
It increases the company's sensitivity to rising interest rates and further justifies a discount compared to its pre-deal valuation.
This instability is also reflected in the dividend policy, which was a very clear signal to the market.
Management cut the dividend to 55 cents for FY 2024-25, down from €1.10 previously. While prudent, the cash is needed for debt reduction and integration, this decision removes the stock from the screeners of conservative income and dividend growth investors.
It signals a company in transition.
Yes, prioritizing capital preservation over income distribution.
The period from 2023 to early 2025 truly felt like the economy was conspiring against them. You had the Chinese destocking crisis and the U.S. capital equipment freeze hitting them simultaneously.
It was a brutal lack of regional diversification benefits. However, we are finally seeing measurable stabilization signals from the most recent Q4 2024-25 results, which is key evidence for the turnaround thesis.
Right. Revenue growth accelerated to 8.3% in the quarter.
A return to growth.
But the most important metric for the future is order entry, not revenue.
Absolutely. Order entry, which predicts future equipment sales, grew a very strong 18.2% year over year. Furthermore, the total order backlog remains elevated at 380 million euros.
Which suggests that the cyclical capital equipment freeze in the U.S. is thawing.
And that demand is returning. Furthermore, the strategic milestone of reaching that 50% recurring revenue base is a fundamental signal that the underlying strategic transition is working, even if profitability lags behind.
Okay, we've established the high underlying quality, the strategic pivot, and the confluence of peak headwinds. We also see stabilization signals. Let's bring this back to the core question of valuation. What is the market pricing in, and is that expectation realistic?
The derating has been exceptionally severe. We noted the stock currently trades at a PE ratio of about 25 to 28 times.
Representing that massive 35 to 40% discount to its historical average of 43 times?
And compared to its primary medtech peer, Alcon, which still commands a PE of around 37 times, the gap is glaring.
So that gap is rationally explained by the market's high anxiety over CZM's deep China exposure and the recent governance issues.
Exactly. But for the critical investor, the question isn't whether the discount is justified, it's how much future deterioration is already priced in.
So what does this all mean in terms of embedded performance expectation? Let's use a reverse DCF analysis to figure that out.
This is the key quantitative insight. If we plug in the current share price, around 40 to 42 euros, and use standard assumptions for the cost of capital, the calculation implies that the market is only expecting the company to grow its free cash flow by approximately 6 to 7% annually for the next decade.
6 to 7% FCF growth for a company in a stable duopoly servicing guaranteed long-term secular tailwinds like global aging and the myopia pandemic. That seems incredibly low.
It is low. Their historical FCF growth rates were often in the 12 to 14% range prior to this downturn.
So what does that 6-7% expectation imply?
It implies the market believes the margin compression is largely permanent. It implies that CZM will lose significant structural market share to J&J. And it specifically implies that VBP will expand to refractive consumables.
The market is pricing in substantial, permanent structural decay.
It is.
Let's define the asymmetric risk-reward profile. What specific scenario unlocks the large upside?
The bull case hinges entirely on management execution and margin reversion. The central thesis is that the pain is transitional. If new management successfully executes the DORC integration, if the cost-cutting program works, and if they restore EBIT margins back to the historical mid-teens range, say 16%, then the company returns to its historical growth trajectory.
And in that scenario?
The intrinsic value moves closer to 60 to 65 euros per share, representing 30 to 50% upside. And this bull case is fundamentally supported by the fact that the shift to a 50% recurring revenue base provides a tangible floor.
In the bear case, the value trap scenario.
The bear case suggests the current price is justified. If margins remain permanently stuck at 11 to 12% due to unrelenting VBP pressure, if J&J competition prevents a strong replacement cycle, and if the local-for-local strategy proves too CapEx intensive, then FCF growth is indeed constrained.
In that case, the current PE is about right.
And there is minimal upside. The ultimate investment decision here lies in assessing the probability of margin reversion versus the probability of permanent structural impairment.
A game of probabilities overlaid on quality assets.
Exactly. Finally, for the listener who is now considering this turnaround play, we need to focus on the wall of worry and the immediate action items.
The immediate catalysts are qualitative and centered on leadership and market stability.
Number 1, the appointment of a permanent CEO with deep medtech commercial experience. The interim arrangement cannot sustain the demands of this fight. The market needs to see stability and focused commercial leadership restored immediately.
And number 2,
stabilization and proof points in China refractive procedure volumes. We need concrete evidence that the consumer downtrading is reversing and that the VisuMax 800 is gaining sufficient traction measured through consumable volumes to offset any price pressure.
If those consumable volumes stabilize and start growing again, it's a strong leading indicator.
It is. So, to synthesize this verdict, we view CZM as an accumulate with caution opportunity. It is fundamentally a turnaround play on a premier industrial asset. It benefits from deep moats, a proven legacy brand, and that successful ongoing shift to recurring revenue.
These factors provide a foundational margin of safety.
They do. The discounted valuation is warranted by the governance turmoil and acute China risk, but the embedded expectation in the current valuation, just 6 to 7% FCF growth, seems overly punitive for a business with such powerful, guaranteed, and structurally defined secular tailwinds.
This leads us to our final provocative thought for the experienced investor. Given that the current discounted valuation seems to price in not just cyclical weakness, but a permanent structural decline and substantial geopolitical risks like VBP expansion and U.S. tariffs, is the market fundamentally underestimating the sheer resilience of the 175-year-old Zeiss brand equity? Is the high IQ investor ignoring the durability of the high switching costs created by the proprietary forum ecosystem, which locks in customers beyond the initial hardware sale? And most importantly, is the market failing to appropriately value the sheer statistical inevitability of global aging and the myopia pandemic, which will relentlessly drive demand for CZM's precise, best-in-class solutions for decades to come? What stands out to you as the most asymmetric component of this trade?